Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Amazon.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And right before we get into today's stock, just a quick heads up about a useful chart tool for those of you looking at the markets. If you want some help, reading trading charts a bit more clearly, you can check out VIP Algos. The link is right below in the description.
Yeah, it's a TradingView indicator suite.
Right, exactly. It basically shows these really clear visual buy and sell chart alerts. Plus it have trend direction tools, support and resistance zones, and areas to help you plan your take profit and stop loss levels.
And you can use it across a bunch of different markets, right? Like stocks, crypto, Forex.
Yeah, gold, indices, futures, all of that. But we do need to be super clear here. VIP Algos is strictly an educational chart analysis tool. It is not financial advice. It definitely does not place trades for you. And, it doesn't guarantee profits.
Yeah. Right. Trading always involves risk. So, do your own research and manage your risk. And just so you know, that link in the description is an affiliate link, so we may earn a commission if you use it at absolutely no extra cost to you.
All right, so getting into Amazon, I want you to imagine pouring $200 billion into one single massive project.
Wait, 200 billion?
200 billion. And doing that before a single customer has even signed a lease. I mean, that is the reality of what we are looking at today.
That's staggering.
It really is. We are tracking a company that is undergoing what's arguably the most expensive, aggressive corporate reinvention in modern history. Right now, in 2026, Amazon is aggressively transitioning away from just being that e-commerce giant we all know. They're turning into what analysts are calling the operating system of modern life.
The operating system of modern life.
Yeah.
That's a bold title. But, a pivot of that magnitude, that comes with a massive price tag.
Well, absolutely. And right now, the broader market is seriously sweating that cost.
Yeah, which perfectly explains the core market story we're seeing on the charts right now. The stock is actually down 8% year to date.
Right.
And in a market cycle where mega cap tech usually dominates and pulls the major indices up, an 8% slide really, really stands out.
Definitely. It's being heavily pressured by this unprecedented capital expenditure plan. They're taking this mountain of cash and just pouring it directly into physical, liquid-cooled AI data centers, along with orbital connectivity projects.
So because of that sudden spending shock, the stock has essentially been pushed into this deeply psychological oversold territory.
Exactly. The market looks at that $200 billion capital expenditure figure, and they are getting severe sticker shock. People are wondering, how long is it actually going to take to see a return on that upfront investment?
All right, let's move into the wealth-building context.
So when you sit down and look at your long-term portfolio, Amazon fits a really specific, fascinating, multi-year growth profile right now. But let's be clear up front, this is not some quick flip.
Right, no overnight wins here.
Exactly. Investors looking at this are basically waiting for a massive infrastructure cycle to play out over the next few years. They are building this incredible matrix of high-density AI data centers on the ground and pairing it with this immensely ambitious satellite internet project up in space called Amazon Leo.
Right, the goal being to provide true global orbital connectivity, right? Like hitting areas that have literally never had reliable access before.
Precisely. But right now, all that heavy building is acting as a severe headwind on their cash flow. I mean, it costs a literal fortune to launch rockets and build server farms.
Yeah, I imagine.
But the core wealth building thesis here is that once these physical projects are operational, they flip. They go from being this massive cost center into a high-margin, recurring revenue tailwind.
So you're basically buying into a transition phase.
Right. You're waiting for the heavy lifting to finish so the toll booth economics can finally kick in. Once it's built, every single data packet, every AI query that passes through their system pays a toll.
Okay, I understand the theory, but I really have to push back here.
Sure.
Because this requires a massive leap of faith. I mean, can everyday risk-aware investors really stomach a multi-year spending spree that just completely crushes short-term cash flow?
It's tough, yeah.
It feels exactly like Amazon is building a $200 billion futuristic city out in the middle of a desert. And right now, before any tenants have even arrived, we're just watching the construction bills pile up by the billions. So why shouldn't you just wait until the city's actually built, the lights are on, and the tenants start paying rent?
It's a highly logical question. But the reason savvy investors often choose to look at this exact transition phase is because, well, by the time the tenants move in and the revenue is clearly flowing, The stock price usually already reflects that success.
Ah, so it's already priced in by then.
Exactly. If you wait for the cash flow to hit its peak, you entirely miss the valuation reset. Historically, the market pays a significant premium for that transition from uncertainty to certainty.
Now let's look at the fundamentals. Because if the market is paying for uncertainty, we need to know if the underlying business is sturdy enough to fund this transition without breaking.
Right, and the sheer scale of their core business is almost hard to comprehend. Their trailing 12-month revenue is sitting right at $716.92 billion.
Wow, 700 billion.
Yeah, and net income is at $77.67 billion, which, isn't just a massive number, but it's actually growing at a highly impressive 31.09% year over year.
31% growth on numbers that large is wild. And where is that profit primarily coming from?
The absolute crown jewel, AWS Amazon Web Services.
Yeah.
Their cloud computing division has successfully reaccelerated to an incredible 28% year-over-year growth in the first quarter of 2026.
Okay, so AWS is reaccelerating.
Big time. That puts AWS at a staggering $150 billion annual run rate. And the operating income for just that one segment surged to $23.9 billion.
That reacceleration is a critical piece of the puzzle.
Yeah.
Because, for a while, cloud growth genuinely seemed to be plateauing across the entire industry.
Right. People were getting worried.
But what's really catching my analytical eye right now is their custom silicon moat. They've developed these proprietary AI and compute chips, specifically Trainium, Inferentia, and the new Graviton 5 processor.
Yeah, the Graviton 5 is a big deal.
And this custom hardware alone is crossing a $20 billion run rate.
And the strategic value of that custom silicon, it really cannot be overstated. By designing their own proprietary chips, they completely stop paying those massive profit margins to external suppliers.
Right, cutting out the middleman.
Exactly. It's like a restaurant deciding to stop buying wildly expensive premium ingredients from outside and instead just buying the entire farm so they can grow it themselves. Suddenly, their profit margins explode.
And the performance is better too, right?
Oh, much better. For the end user, the new Graviton 5 chip offers 30 to 40% better price performance than competing graphics processing units on the market.
Which means it saves an enterprise client literally millions of dollars on their server bills.
Right, and that is exactly how you lock enterprise clients deeply into your ecosystem. You offer them raw compute power that is simply cheaper and faster than what they could ever build themselves or, get from a competitor. It makes switching away from AWS financially irresponsible.
Okay, but then we hit the balance sheet. And here is where the math makes me incredibly skeptical.
Okay, let's hear it.
Let's talk about the free cash flow. Currently, it is sitting at a negative $7.7 billion. That is a negative number with a B. And that deficit is entirely due to the $131.82 billion in trailing capex they've spent.
Yeah, it's a massive outflow.
So how can anyone look at a deeply negative $7.7 billion free cash flow and claim this business is in a financially healthy position?
I completely understand the hesitation. Seeing negative free cash flow on a company this size, it sounds terrifying on the surface, but we have to look at the exact opposite side of the ledger to understand why it's happening.
You mean the operating cash flow?
Yes, the operating cash flow. Before they spent a single dime on new futuristic buildings and orbital satellites, the actual day-to-day core business generated $148.5 billion in operating cash flow.
Okay, that is a huge cushion.
It's incredibly robustly healthy. So that negative free cash flow we're seeing, it's a deliberate strategic choice to reinvest heavily into high-return future projects. It's not a structural bleeding of their core business operations.
Even so, that is quite a tightrope walk. They are essentially spending everything they make and then reaching into their pockets for more.
They certainly are, but they're also securing massive liquidity cushions to protect themselves from, any macroeconomic shocks.
Like the recent bond offering.
Exactly. They just completed a massive offering of corporate bonds in Canadian dollars. They originally aimed to raise 14 billion Canadian dollars, which is roughly 10 billion US.
And how did the market respond to that?
The demand from institutional creditors was so overwhelmingly high that it was oversubscribed at 28 billion Canadian dollars.
Wow, double the demand.
Double. The corporate bond market, which is notoriously strict and risk-averse, is essentially fighting for the right to lend Amazon money.
Right, because those massive institutions view the long-term asset value of those data centers and networks as rock-solid collateral.
Exactly. And on top of that credit demand, there's a potential $5 to $8 billion financial windfall coming their way soon.
Oh, from the tariff.
Yeah, a recent U.S. Court of International Trade ruling formally invalidated certain Section 301 tariffs. To keep it simple, these were specific taxes imposed on various imported goods.
Right.
Because the ruling invalidated them, it could trigger a massive cash refund for past taxes paid. That gives Amazon an unexpected pure cash liquidity cushion right at the exact moment their CapEx spending is peaking.
That brings us to the catalyst timeline.
So, if the fundamentals are the engine, the catalysts are the spark. What is actually going to move the stock in the next 3 months? The big immediate one is Q2 2026 earnings, which are on July 30th.
Right. And all eyes are going to be hyper-focused on exactly what we just debated, the AWS metrics, and the tangible return on investment for that CapEx. If they're spending $200 billion, Wall Street wants undeniable proof that cloud revenue is accelerating fast enough to justify it.
Exactly right. And then shortly before that, you have Prime Day, usually late June or early July.
Which is huge for them.
Huge. And it's no longer just about selling discounted retail goods. Prime Day has morphed into this massive gauge for broad consumer resilience.
The global demand for AI is continuously validating Amazon's infrastructure spend.
Absolutely.
I mean, we just saw TSMC, the Taiwan semiconductor manufacturing company, report a staggering 30% revenue surge in May alone. That physically proves the underlying demand for AI compute hardware is real, which directly benefits AWS.
And then there is the absolute wild card.
The Apple thing.
Yes, the highly speculative but incredibly fascinating potential synergy with Apple. Amazon recently acquired a satellite communications company called Globalstar for $11.6 billion.
Okay.
But here is the massive kicker. That acquisition automatically included Apple's existing 20% equity stake in Globalstar.
Okay, wait, let me pause you right there. Are these catalysts actually going to move the needle, or is this all already priced in?
Well,
because analytically, this Apple and Globalstar rumor feels a bit like strategic speculative noise. Like maybe it's designed to distract retail investors from those massive CapEx bills. An exciting rumor about a future partnership doesn't pay the very real bills for satellite rocket launches.
it is definitely speculative. There's absolutely no denying that. But it's importantly grounded in a very real, legally binding transaction. Acquiring a company where Apple already holds a 20% stake creates an undeniable forced strategic intersection between the two largest tech companies on Earth.
So they have to interact.
Exactly. Even if a direct-to-device network partnership takes years to materialize, the stock market inherently trades on future potential. When you suddenly possess an asset that connects cloud computing with global mobile device networks, the market is forced to reprice the absolute ceiling of what Amazon can achieve. Now let's pivot to the chart.
Yeah, let's look at the technicals.
Taking all those upcoming catalysts into account, how is the market actually reacting? Right now, the stock is sitting in a psychologically oversold state. The Relative Strength Index, or RSI, is at 34.37.
Just for a bit of context for you, an RSI under 30 is traditionally considered heavily oversold by technical traders. It means the selling pressure has potentially exhausted itself. So a 34 means it's hovering right on that dangerous edge.
Right.
And it's sitting well below the average Wall Street analyst price target of $312.79.
And what's really telling is the institutional volume flow we saw on April 14th, 2026. That was the day the Globalstar acquisition was officially announced.
Oh, the volume was insane that day.
Amazon traded an incredible 70 million shares that day alone.
Okay.
To put that in perspective, their normal average daily volume is around 50.9 million.
So a massive spike.
Yeah, and despite the high cost of the acquisition, the stock closed up 3.81%. When you stretch a rubber band too far, it snaps back. In trading, that's called a mean reversion bounce.
And this is a classic example of why having the right chart tools genuinely matters. When you see an RSI push all the way down to 34, and you suddenly notice a massive volume spike on key news, those are the exact support and momentum structures that technical tools are uniquely designed to help you visualize. It signals clearly that major institutions might be stepping in to buy the dip and absorb that initial CapEx shock. Tools like VIP Algos are built precisely to help you see those visual alerts clearly, so you can map out your own take profit and stop loss areas. Though, just remember the chart always shows probabilities never guaranteed outcomes.
Right, it's about probability. But the unusually high volume tells us that the major big money players looked at the $11.6 billion acquisition not as reckless spending, but as a deeply calculated expansion. They bought the dip heavily.
So what does market sentiment look like?
If you aggregate the opinions, the overarching mood among major analysts is officially cautiously bullish. Wall Street clearly sees the long-term revenue potential of marrying AI cloud with a global satellite network, but they are still actively sweating the reality of that negative free cash flow.
It's a massive tug of war between future vision and current reality.
It really is. On one hand, Bank of America is strongly maintaining a $310 price target. You also have Barclays publicly endorsing the satellite internet space, explicitly noting that orbital connectivity isn't going to be a winner-take-all market dominated entirely by SpaceX.
But the most important sentiment indicator isn't just reading analyst notes, right? It's watching where the smartest, biggest money is moving.
Exactly. And whale-level institutional conviction remains rock solid here. Bill Ackman, the legendary hedge fund manager, recently increased his overall holdings in Amazon by a massive 19%.
Hold on, I have to jump in here with some skepticism.
Sure.
Are we entirely sure that Wall Street analysts and mega fund managers aren't just stubbornly defending a mega cap stock out of pure habit?
How do you mean?
Well, sometimes these massive funds systematically add to their positions simply because they're forced to hold the major index movers just to keep pace with the S&P. Ackman might just be parking money in the biggest index mover available. Is this real conviction or just systemic inertia?
It's a fair question whenever you see big money moving. However, a 19% increase from a highly active, fiercely concentrated manager like Ackman isn't a passive index habit.
Because his portfolio is so focused.
Exactly. He runs a famously focused portfolio with very few positions. When someone with his strategy increases their stake by nearly a fifth during a period of terrifying capital expenditure, it is a highly deliberate, thoroughly calculated bet on the intrinsic value of the company. He's looking straight past the near-term cash flow headwinds. Now let's talk about the risks.
Yeah, we have to.
We absolutely have to outline the downsides, honestly, because a $200 billion bet inherently comes with an equal amount of peril. Risk number one is what leading analysts are grimly calling the CapEx treadmill.
Right. We talked about how the sheer volume of CapEx has erased the free cash flow for now. The risk here is brutally simple. What if the actual return on investment for all this expensive AI infrastructure drastically disappoints?
That's the nightmare scenario.
If the global enterprise demand for AI compute doesn't grow fast enough to continually fill these massive new data centers, that near-zero free cash flow will trigger a severe, punishing valuation reset. The market is generously giving them the benefit of the doubt today, but Wall Street's patience will eventually run out.
It will. And the second major risk revolves entirely around their space tech operations. Project Amazon Leo is facing serious, tangible operational bottlenecks.
Right.
We're talking about literal rocket science here, which is famously unforgiving. They've had to deal with catastrophic Blue Origin launch pad explosions and highly complex United Launch Alliance Vulcan engine anomalies that are delaying their schedule.
This is exactly what I mean about unquantifiable risk. It's one thing to have a software bug delay an app launch for a few weeks. It is an entirely different reality when your primary infrastructure vehicle literally explodes into a fireball on a launch pad.
Yeah, it's visceral.
You can't just patch a blown-up rocket engine with a quick software update.
Oh.
The physical execution risk here is completely off the charts compared to traditional tech.
It is incredibly risky, which is exactly why that Globalstar acquisition is viewed as so strategically brilliant by the big funds. It acts as a direct, immediate hedge against those physical launch failures.
Because Globalstar already has satellites up there.
Exactly. They possess an existing, fully operational satellite constellation, and crucially, they hold highly coveted spectrum licenses.
The legal right to broadcast, right.
Right. Think of a spectrum license as the invisible real estate of the sky. It's the strict legal right granted by governments to broadcast data on specific frequencies without interference. By buying them outright, Amazon entirely bypassed years of ground-up legal development and launch bottlenecks.
That makes a lot of sense.
It ensures they have a working footprint and legal broadcasting rights in space today, while their engineers painstakingly sort out the rocket engines for tomorrow.
So with everything on the table, what's the final verdict?
Based strictly on the verifiable facts, the underlying fundamental momentum, and the historically oversold technical setup we discussed, the final bullish score for Amazon sits solidly at an 8 out of 10.
which firmly puts the investment stance at moderately bullish. It's a highly asymmetric entry point right now, largely because of those deeply oversold technicals. The broader market has heavily priced in the fear of the CapEx spend, but perhaps hasn't fully mathematically priced in the undeniable operational dominance it'll ultimately yield.
And the specific time frame you need to keep in mind here is a multi-year view. We're looking at a multi-year hold profile, specifically looking out over the next 12 to 18 months.
Right, you have to be patient.
Immensely patient. You're waiting for that CapEx cycle to finally convert from a scary cash flow drain into a high-margin, unstoppable revenue engine.
And as always, we want to remind you clearly that this analysis is strictly for informational purposes and is absolutely not financial advice. You're looking at a company attempting to aggressively build an orbital global network and an AI compute monopoly at the exact same time. It really leaves you wondering, when Amazon successfully becomes the undisputed operating system of modern life, will global governments even allow a single corporation to hold the keys to both the cloud and the sky?
It's a huge question.
Definitely. And if you want a cleaner way to read trading charts as you research companies like this, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite equipped with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can genuinely help make complex charts easier to scan, but it is still only an educational chart analysis tool. It's not financial advice, it does not place trades for you, and it does not guarantee results. Trading always involves risk, so always do your own research and manage your risk appropriately. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.